Hi friends. So we'll start the next series of multi-bagger stock. This is the fifth episode, and I'm now giving the fifth stock for a multi-bagger series. The stock name is Happy Forgings Limited. This is a recent company which was listed in 2023. A very good company with fundamentals, and this is into the forgings industry, as the name suggests, and a company with a very strong fundamentals and good management, which becomes a perfect recipe for becoming a multi-bagger stock. So we'll just deep dive into this stock now. So as I've told you in previous slides, what do we mean a multi-bagger stock? A stock which can give you a return of more than 100% of its initial investment. That is called a multi-bagger stock. For example, a stock that quadruples in value is a four-bagger, and a stock that increases five-fold is a five-bagger. This multi-bagger word was actually coined by Mr. Peter Lynch, a great renowned investor in US, in 1988 book on Wall Street. It comes from baseball, where a number of bases a runner reaches is measure of play success. So we'll also start with a quote which is given by Peter Lynch: "Know what you own and know why you own it." So this is very essential that whenever you're buying a stock or whenever you're buying a company, actually you're buying a business. So you should exactly know why are you buying that stock, for how long, who is the management, why exactly this business is going to grow, and why exactly this particular ownership of the stock will make you wealthy. So a basic fundamentals and basic study on the business and company is actually to be understood before implementing or before investing a huge chunk of money in any of the stocks. So this is what was told by Peter Lynch, and I strongly feel this is the way forwards for investing in any stock. Again, a quote from William Feather: "One of the funny things about the stock market is that every time one person buys, another sells, and both think they are astute." So, of course, whenever a deal is happening in a stock market, has to be a buyer and a seller. So, whenever a person is buying a stock, he understands why he is buying a stock, and he's pretty sure on the fundamentals and the long-term growth of the company. And a person who's selling a stock, he also knows that the story has finished, and probably this is the time to get out of this stock, maybe for a short term, maybe for a long term. So this is the beauty of the stock market, that you will always have a divergent views, and that's the reason why you will have a buyer and a seller. So whose study is better, and probably what are the compulsions for exiting the stock, and what are the reasons for buying a stock? This is what the evaluation is being done for buyer and seller, and this is how a trade happens. So that's the beauty of the stock market. In terms of characteristics of any multi-bagger, we want a company with very high revenue growth, because the top line is good. That is showing that the business is expanding. The company is taking a large pie in that particular business segment, and also that company is showing a very renowned growth on the top line, which can increase its overall intrinsic value and the overall market capitalization of that particular company. It should have a large addressable market. We don't want a company which is good in management, which has all strong fundamentals, but the addressable market itself is very small. That we never want, because that will it's not that the stock will not grow, but it is very difficult for that stock to grow multifolds. And here we are looking for stock which can grow multifolds. So for this, a very important parameter is that it should have a large addressable market. It should have a disruptive potential as much as possible. May not be very essential, but if the stock has the potential to do disruptions, then the growth becomes very fast, and the multi-bagger returns can come very fast. It should have strong fundamentals. This is absolutely important. Whether other things can be compromised, but this thing cannot be compromised. It has to have very strong fundamentals. The company has to have solid financials, including robust revenue growth, increasing profits, healthy cash flow, and some other parameters which we'll see in forthcoming slides. This is utmost essential for any stock to be picked up for growth and investment. Again, a quote from Mr. Warren Buffett: "Market fluctuations are your friend, not enemy." Again, very, very important thing. See, if fluctuations don't happen, then the exchange of stocks will not happen. Then the change of hands will not happen. In any kind of a bear market or a bull market, there is always change of hands. For example, in a bear market, the weaker hands will move out and stronger hands will come in. And this change of hands actually helps you to acquire a good story but at lower price. So for any factors, if the stock is decreasing, for example, there is a global war, there is For example, there's a financial crisis, which is temporary, which will last for 6 months, 10 months, year, 2 years, but it is not the end of the world. That is the fluctuation where you should enter into a good business, because that makes your entry level very good. And once you enter at a very low price, then the increase of that stock value, or for example the uh, multiple returns that we're expecting, becomes very very easy. So that's the best part, that so these market fluctuations should not be taken as a surprise. They should not be taken as an enemy. They're actually your friend, because they are allowing you to enter into a business at a cheaper price, at an undervalued price. So that is very essential. We continue with the characteristics of multi-bagger stocks. So low debt to equity ratios. Generally, I don't like stocks which have high debts. The reason is very simple. See, if you have a high debt, and if anything changes in the global scenario, for example, in 2008 financial crisis, what happened? The companies were having large debts because every company was going for expansion. The world economy was growing at a staggering pace of 6 to 8%, and India was growing at a staggering pace of 10 to 12%. So the capacity utilization of the industries became very high, and every private player or government player wanted to expand its business. So steel industry wants to have new plants, cement industry wants to have new plants, banks wanted to have new branches, etc., etc. So the expansion was very large, and that is why debt was taken. But suddenly, when the crisis came, these were the companies who became actually non-payers to the bank. They created a lot of NPAs, because suddenly, when the scenario changed, your investment, what you the debt that you have taken, you still have to pay for the interest income and other expenses. And since the business has become on the lower side, your payment to those things becomes even more demanding. And that is where we don't like this larger debt companies, because if any change in business scenario, any change in global scenario, any competitive disruption or any technology disruption, these things can actually damage your entire company's profile. For example, if we talk about Kodak, this was one company which was the market leader in cameras. We all know how Kodak cameras work. They were actually market leaders, but they missed very important point of digitization. So they thought, no, the the excitement of having the photo in your hand, the paper in your hand, makes you much more exciting than watching it digitally on the laptop or phone. And they never understood that this is the story of the future. They always thought, no, the paper feel will always survive. And you know what has happened to Kodak? It became bankrupt, and it was absolutely wiped out from the market. So good company with good fundamentals also get wiped out if at all they don't change. Higher return on equity, yes, of course, we want that higher returns on equity should be there. That only makes it multi-bagger. We want the management to be absolutely agile. We want it to change. We want to invest the management in R&Ds, capacity expansions, knowledge. They should be ambitious with a good motivation and very high moral values. These are absolute essentials for any company to grow. P expansion justifies the exponential rise in the stock price. Actually, if P expansion happens, so your EPS is also increasing, and if your business is growing at a staggering pace, and if at all the industry is also expanding, that makes your P expansion very very fast. So then your return becomes very very fast because of two advantages. One is your EPS is growing, and secondly the P is also growing. So 2 into 2 becomes 4. That kind of advantage happens. So we always want to have companies with P expansion, but this you cannot anticipate. It happens by time. It happens considering the business scenario which is changing. It cannot be planned. It can happen as the time passes by. So this is, but if it happens, it is always desirable, because if it happens, then your stock multiplies in a very smaller time. So, as I told, that management is a very important part for any company to grow. That is actually the architect of progress. So, in terms of this company which you've chosen, Happy Forgings, Mr. Paritosh Kumar, he's the CMD of the company. 45 years experience in the industrial sector. He's involved in the strategic decision making of Happy Forging, oversees the company's business, etc. Then we have Narinder Singh Juneja. He is 50 years experience in the industrial sector. So again, very highly experienced person. We have Pankaj Kumar Goyal, who's a CFO, and another 23 years of experience in the financial sector. Then we have Patwinder Singh. He is a CFO, again 22 years of overall experience, and he has taken a master's in business administration from CSM Institute of Graduate Studies. We have Mangesh Santaram Pundare. He is the CFO. Again, 27 years of experience in marketing sector. We have Ashish Garg, MD, is 17 years of experience in the industrial sector. So all these bigger stalwarts in the company, all those bigger leadership positions are held by people who have great experience, a large experience, who would have seen a lot of industrial cycles, ups and downs in the markets, and probably they know the mantra of steering the company in bad times and how to increase your escalator or increase the speed of escalator when probably you have good times. So this is why it is essential to have a good people on board. Again, they have a very strong set of independent directors as well. So it that makes it a diverse board in terms of professional and industry experience, age and gender. Majority of the people in the boards are independent directors, 5 out of 9. There are two female directors in this. Three committees out of five are headed by independent directors, so it makes it much more transparent. 280 plus years of collective experience on board members. That is the beauty of this company. I think this much years of experience can only bring a lot of richness into your overall decision making and overall view and how exactly you're seeing your business in the future. 165 years of collective experience of independent directors and 58 years average age of board members. So very, very experienced team. We have Mr. Satish, who's 48 years of experience. He is currently into JK Files and Engineering Limited. All these are independent directors. We have Mr. Ravindra. He's from Savita Oil Technologies Limited, Muthoot Finance. Mrs. Rajeshwari, she is into Craftsman Automation and Bellspur Microfinance. She's into credit ratings and appraisal, financial and economic research. We have Mr. Atul Behri, who's business strategy and operations and currently into Dixon Technologies, MD and Vice Chairman. So again, a very renowned person, and we know how exactly or how well the company is growing of Dixon. Mr. Vikas, he's again from Vixun Consultants Private Limited. He's overseeing his areas of expertise are finance and accounting, project financing, and corporate restructuring and insolvency. So that's how the independent board is made about. We already seen the board members of the company. That is from the core company, and these are the independent directors. What is this company actually is? So this company was incorporated in July 1979 with the name of Happy Forges Limited. This is an Indian manufacturer specializing in designing and manufacturing heavy forgings and high precision machined components. So they are into very highly heavy kind of forgings and heavy industrial sector, which we call it. They have a revenue of around 1358 crores, that is, we're talking about FY24, and a very high EBITDA margin of around 28.5%. They have experience of around 45 years now. They have three manufacturing facilities and with a forging capacity of 1.27 lakh tons. They have a machining capacity of 57,000 tons. So that's what the capacity is about. They are the second largest producer of commercial vehicles and high horsepower industrial crankshafts in India. They are the fourth largest engineering led manufacturing of complex and safety critical heavy forged and high precision machine components in India. This is what these companies of excellence is. They are into CRISIL and ICRE has given us AA stable ratings, and they have a very diversified customer base. So we already seen this. So this Indian manufacturing company, Epi Forgings, is into designing and manufacturing of heavy forgings and high precision machine components. It's the fourth largest in terms of complex and safety critical heavy forged and precision machine components. Again, a quote which I always like to remind myself and the viewers. Usually, a very long list of securities is not a sign of brilliant investor, but of one who is unsure of himself. See, if you have 1 lakh to invest, you should not have a portfolio of 20, 30 stocks. You should have only 5 stocks. Even if you have 10 lakhs rupees to invest, you should have maximum 10 stocks. So it does not mean that the maximum the larger the number of stocks, the more advantage you have. Actually, you have a lesser advantage. It shows that you have less confidence on the stocks that you have chosen. Your character is not to have patience, and of course, it is showing you that your grip on the fundamentals and the companies is not so proper. That is why you are diversifying yourself too much. So that's not the best way of investing. You should have limited stocks with high conviction and high value. When they convert into multi-bagger, then the wealth is created. So for example, even if you have 1 lakh rupees and if you've taken 30 stocks, that means you've invested around 5,000 or let's say 3,000 rupees per stock. So even if it becomes 100 times, you're only reaching to around 3 lakh rupees, which cannot make you wealthy. But if you invested even 10,000 rupees in a particular stock, if it becomes 100 times, it becomes 1 lakh, 10 lakhs. So again, that will create wealth for you. So the number of stocks should be absolutely limited. The research should be proper. Once you're investing, and if once you have high conviction, always invest in high quantities. We've already seen on the scale, infrastructure also we have seen products. So 70% of project production coming from heavy lines. 85% revenues of this company comes from machine products. This is we're talking about FY24. Manufacture of high precision components and with a very low tolerance of 5 to 10 microns, because most of the products are being utilized, most of the products that they are making, they are utilized in automobiles, windmills, and very heavy industries where the accuracy requirements are very high. So that's why we are talking about the tolerance of so low, 5 to 10 microns. The customers have they what they have is long standing relationships. We'll see in the forthcoming slides why they have to have long term customers only. They have diversified customer base of around 60 plus customers. They have more both domestic and global customers and successful track record of wallet share expansion. So continuously they are expanding into new products, which is very essential for their business growth. Financials we'll see in the forthcoming slides on a greater view. Only thing is that their very debt is very limited, so it's around zero point 0.1 times the EBITDA. So the debt is extremely limited. If you see their journey, so they started in 1979, which they started only as a single unit for manufacturing only bicycle crank arms. But by 2005, there were heavy duty hammers installed for oil engines and major parts production. By the year 2008, they initiated the installation of 8,000 tons forging press line and model grinding for around 4 to 6 cylinder crankshafts. By 2015, they expanded this and entered into commercial vehicle and industrial segments. By 2018, they commissioned another 8,000 ton forging press line. By 2022, they installed 8 single piece flow lines for crankshaft and the third 8,000 ton forging press line and commissioned 14,000 ton press line as well. So again, great expansions, how they have grown in the years. By 2023, they actually had an IPO in 2023. We all are aware of it. And by FY25 now they have installed capacity of 6,300 tons press and plans to install another 10,000 tons of forging press line. So I think they are continuously expanding. The industry is also expanding, and that's a good news for us if we are investing in this particular stock. In 1979, they established a single unit for bicycle crankshaft. We all know that. Then we have seen this many of the things. They started in 2005 with heavy duty hammers installed for oil engine and motor part production. And we've already seen most of the content of the slides, so we'll skip it. So they are into forging business, they are into machining business. They have die design and manufacturing, so latest technology and tools to offer a wide range of services, including design, prototyping, testing, and manufacturing. They have huge metallurgical facilities equipped with a range of advanced metallurgical testing and analysis equipment to ensure the highest quality in the forging and manufacturing process. They also have heat treatment facilities. This is equipped with technology and equipment to provide precise and effective heat treatment process, very essential for any forging industry. And of course, you have a quality control and quality assurance unit, because these are again very high precision with a low tolerance kind of components. This is a process flow. I'll not go into details because this is probably we are getting too much into the forging process, but just do it in a faster way. So you get raw material in the yard, then you have billet cutting section, then it goes to metallurgy testing lab, then you actual forging happens, then the forged product goes into machining part, and machining happens, then it goes for heat treatment, then controlled cooling, then standard room, final inspection, and that makes it prepare for packaging and dispatch. So product portfolio, they have crankshaft, we already seen. They have front axle carriers. They are into essential components used in the front suspension system of vehicles, particularly in commercial vehicles. They have steering knuckles, precision forced components used in vehicle steering and suspension systems. They connect the steering control arm to the vehicles. They have differential housings, automotive drivetrain systems, transmission parts, pinion shafts, suspension products, precision forged shafts used in differential and transmission system. They have valve bodies. They also have products which are used in oil and gas, power generation, industrial machinery sectors. Valve bodies which regulate the flow of fluid within the machinery systems. And they also have suspension related forged components which are used to absorb and dampen shocks in vehicles. So very diversified portfolio, mostly into vehicles, commercial vehicles, and other passenger vehicles, and this kind of products is what the company is offering to us. So they have three manufacturing plants which have total manufacturing forging capacity of 1.2 lakh metric tons and around 15,700 tons of machining capacity. They are into automotive or non-automotive both. So in commercial vehicles, they are into crankshafts, differential housings, front axle carriers, and transmission parts, catering to automotive industry, especially commercial vehicles OEMs. In non-automotive, they are into wall bodies and various industrial forgings, catering to farm equipment, off-highway vehicles, oil and gas, power generation, railways, and wind turbine industry. Clientele, they have actually all good clients you can think of. So Ashok Client, SML, AAM, and India Manufacturing Corporation, Born Fujilok Transmissions, Dana India, IBCC Industries, International Tractors, JCB India, Liebherr, CMC, TEC India, Mahindra Mahindra, etc. So they have all the bigger clients which you can think of in terms of heavy commercial vehicles and other passenger vehicles. Revenue, it comes mostly from commercial vehicles around 42%, then farm equipment it's around 31%, industrials 12%, off-highway vehicles 13%, passenger vehicles 1%. Exports, they have a good mix of exports now. So 20% of the overall revenue by FY24 has come from exports, and they are actually customer base are located in 10 different countries. We'll see details in the forthcoming slides. Again, a very important quote. So, if you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. So, once you choose your stock and company, which is a long term story, invest and forget about those companies. You should not be worrying about the market volatilities going up, down. So, like as of now, which we are seeing the US led volatility into the markets, or sometimes related to our earnings and all. These are all very temporary things. These are cyclical things. They are not structural things. And we should actually understand that these things will happen in the markets. The graph is never linear. It will have ups and downs. But if you have a good story to rely on, probably you just sit and relax and just don't see the markets too much. That's what the quote says. So, product mix, if you see that 85% of FY24 revenues came from machine parts, which have higher realizations and margins compared to forged products. So, they mostly want to get into machined products. And we already seen the capacity is around 57,000 tons. They have installed a 6,300 ton forging press in Q1 FY25, and they're going to add more uh, in Q1 FY25, Q2, and Q3. So, we'll continue to watch this. Again, a quote from Warren Buffett: we don't have to be smarter than the rest, we have to be disciplined than the rest. That is why I say you don't have to get in and get out of the stock too frequently. Just stay there. Don't try to time the markets. Don't try to be happy that I've uh, you know bought a stock at 6,000, sold it again at 8,000, then again bought a stock at 6,000, or let's say 7,000, sold it at 9,000. By doing this, you will always miss the bigger chance. You will always miss the bigger companies. You will miss the real stories, which we never want. The stories are here to continue. The price will fluctuate here and there. So if you remember, we all talk about Mr. Rakesh Jhunjhunwala, who has made a lot of money in Titan. People say that if you invested around 10,000 rupees in 2003 in Titan, this is worth 8 crores. But if you see the graph of Titan, it has not done anything for 8 years. So he was still disciplined. He was still, a great believer of the story of the company, that he continued his investment for so long, and that is how the fortunes were made. So that discipline, that kind of confidence, that belief has to be there. That always. So it's not that knowledge only matters. It's actually your characteristic, your mental capacity is very important in stock markets to make money. So they have multiple products, as we already see, in multiple industries. So in commercial vehicles, they are giving front axle components, rear axle components. They're giving suspension products, crankshaft, differential cases. In power generation, they're mostly given only crankshaft. In farm equipments, they're giving crankshaft, crown wheel, axle shaft, and pinion. For windmill applications, they're giving housing, output shaft, and planet carriers. Again, for passenger vehicles, also they are giving crankshaft, they're giving brake, flange, and knuckle. So these side photographs actually tells you where exactly these products are used in the vehicles. You can see those things. Again, for farm equipment, they're giving you crankshaft, crown wheel, axle shaft, pinion. So again, the photo shows where exactly these components are used. Uh, for the off-highway equipment also, they're giving bucket, link, and crankshaft. So again, a very diversified product portfolio. That's a good thing. For power generation, they're only giving crankshaft. Of course, we all know that this is a very important component for any DG set to function. For windmill, they're giving housing, output shaft, and planet carrier. So again, very critical components. For oil and gas industry, they're giving you valve bodies. For railways, they're giving piston pin and connecting rod. So these are the product applications. So commercial vehicles, passenger vehicles, farm equipment, railways, off-highway equipments like excavator, JCB, and all, power generating equipments, oil and gas, and windmill. So they are into very diversified product applications. They have demonstrated the ability to install and operate high tonnage press lines and precision machining. We already seen they have 1.27 lakhs of forging capacity and machining capacity of 57,000 metric tons. So they have a plant in Kangawal. This is first plant, and they have also commissioned second plant in 2006. These both plants in Ludhiana. Third is in Dugri. Again, this is in Ludhiana, which started in 2021. The strategic location facilities, these are located near inland container depot facility in Ludhiana and dedicated freight corridors. Very essential, makes your price lower, and anyways the logistic cost has to be controlled nowadays. Continuous investment in in-house infrastructure, installed a new 14,000 ton press, makes Happy Forging Limited the only second company in India to have such press or higher forging presses. They have ability to forge heavier and complex parts up to 250 kgs to cater to different industries which require heavy and complex parts. Operating efficiency, because fungible project lines along with vertical integrated facilities helps drive drivers product offering, reduced operating cost, and improve productivity. So already we've seen these three industries, the facilities, three manufacturing facilities that they've added. And if we see from FY20 to FY24, they were having only a forging capacity of only 67,000 tons, which has now reached to 1.2 lakhs plus. And the machining capacity, which was only 29,000 tons approximately, has now reached to around 55,000 tons. If you see their debt ratio, we already seen it's less than 0.1x. So I'll skip this part now. So these are their global footprints where they are actually exporting their products. They are into US, Brazil, UK, Spain, Italy, Germany, Sweden, Turkey, Thailand, and Japan. So again, a very diversified portfolio in terms of world exports, and they're exporting to 10 countries. Even their export revenue into the overall revenue is continuously increasing. So if you see FY21 was 9%, now it is 20% of the overall revenue of the company. So that's again very good that they're into export as well. The product mix, that actually the machining, if you see the forged products, so they have increased from 27% to 73% now, and for FY24 it has slightly decreased. So now the machining is done more, it is 85%, and the forging products are only 15% of the revenue. So there's a shift, and that is what the company want, because those are high margin products and specialized products. In terms of sectors, if you see the increase in share of industrial business leading to a further diversification of the business. So if you see the industrial business contribution in FY21 was only 2%, and now it has been increased to 12%. So that is what the company wants. And anyways, we've seen the rise in export figure in the previous slide. So I'll just skip this. Strategically adding capacity with a strong focus on capital efficiency. So we already seen that 1.2 lakhs has been now made to 1.27 lakhs of forging capacity. Even the machining capacity has been made to 57,000 tons from the current, or from the FY24 of 51,000 tons of machining capacity. So continuous increase of capacity, that shows that the company is seeing higher business, and higher business convert in higher business efficiency, as well as they're able to increase exports also now. How they are creating a lot of value creation. So they are transition from a forging led player to a leading manufacturer of machine components in India. In-house design capabilities and fungible product lines have led to a diverse product offerings, continuous value addition, increasing global presence through increase in direct and indirect exports, increased wallet share from customers by offering additional products to existing customers, track record of consistently building capabilities and infrastructure with a focus on capital efficiency. That is how they are creating value Nutshell, if you see, they are continuously increasing their capacity, and they are increasing the revenue mix into global exports as well. And the product portfolio is also continuously getting customized to cater for more and more industries. That's the nutshell of it. So this is very important slide, and I'll just take 2 minutes on this. So the advantage with this company is that the high entry barriers. Now, for any business, if you have a high entry barrier, that means that the disruption in this industry chances are very less, and uh, that makes the investor even more confident that he can be invested in this company for long time, because the newer players will find it difficult to enter into this industry or to their customers or to their clients. Why? So first is capital intensive. Yes, so it's a capital intensive business that involves complex technology, machinery, and systems, acting as an entry barrier for smaller and unorganized players. So that is very important part, that it's very capital intensive, and it is complex technology for which every player cannot enter. They have strategic resilience, so they have lengthy customer and product approval process. So if you see the products which I have seen in the previous slides, they are very customized for a particular vehicle, machine, windmill, diesel generator. So when you are doing a custom based product for any industry, it takes a very long process, because these are very important components. Camshaft in any vehicle is very important, that cannot fail. So it has to go through a very intense examination, drawings, engineering, then testing, then quality assurance. Then only you can allow that product to be used in these kind of essential applications. And once you go through that process, then you don't want the process to be repeated to other vendor also. That is why it will become an entry barrier. For example, once the product is finalized for a particular vendor by a client, he will not like to bring in new vendors, because the process itself is very long. They have selected supplier dynamics, so difficulty in acquiring new customers without existing relationships. So anybody who wants to enter into this industry will have to approach those same players. So even in India also, the passenger vehicles or the commercial vehicles manufacturers are very limited. We have a show client, for example, SML, for example, M&M. So you don't have a range of bigger companies where any new vendor can enter and collaborate with the existing players. To those will people. So for example, anybody goes to Mahindra, he will always say, no, I already have my existing vendor, and I don't want to experiment with another people. So that actually makes a entry barrier. Precision. So importance of implementing and sustaining quality systems while providing critical and high precision components involving tight tolerances. And if anybody who belongs to engineering background, so I actually an engineer, so I can understand all these things. It takes a lot of hit and trial, and it takes long R&D and long engineering to create these kind of products. It's sometimes it's 3 years, 5 years process. So, and especially when you are leading into a product with very high tolerance, it comes with a lot of time spent, a lot of quality changes, a lot of hit and trials, a lot of engineering, a lot of experiments. That is why once you attain those kind of precisions, you will never like other vendors to enter into the market. The client will always be very comfortable with the existing set of vendors. Product reliability. Global industry leaders are highly selective in qualifying new suppliers with respect to critical products, given the high cost of risk in switching suppliers, especially where products reliability is critical. So if you see windmills, now they were giving those critical component in windmills. If at all you enter a new vendor, and if the product fails, every wind turbine will be costing in crores, hundreds of crores, 100 crores, 500 crores, 1,000 crores. And if it falls, if it gets breakdown, the amount of loss of business to the client, the amount of loss for reputation, and the overall infra cost itself becomes very high because of this low components. So this kind of product reliability is established over 5 years, 10 years. So for example, if the company is saying my product will give you a, let's say, lifespan of 20 years, so to test that lifespan itself you need 20 years. So if a company has given you that kind of reliability, now it is very difficult for another person to enter and say, no, I'll give you the same thing, because the process is 20 years long, 10 years long, and no client will like that. So that again makes it a very big entry barrier for another company. Very good robust track record, so they have been increasing their finished product volumes in FY20. If you see, it was around 30 2,000 tons, it has now reached to 55,000 tons with a CAGR of 14%. Even EBITDA per kg has been increasing very steadily to 70 rupees now, and it's around 12% CAGR. Key financials, if you see revenue, it has been increasing with a CAGR of 25%. So in FY20, it was 558 crores. Now it is reached to 1358 crores. And if you see the PAT also, from 80 crores, it has reached to 243 crores. So it's increased by almost three times in last 5 years or 4 years. So very staggering CAGR of 32%. So very, very impressive key financials. Strategic priority. So they have in-house capabilities of product development. That is very essential if you want to if you want to become a leader, and the kind of quality clients that they have. Enter lightweight forging and machining for passenger vehicle sector, although it's only contributing 1% of their revenue as of now. They expand wallet share and acquire new business by leveraging existing OEM relationships. That's perfectly fine. Capitalizing on increasing demand from international markets to grow exports. So we have already seen the exports are increasing of the revenue mix. Expand capacity. Yes, of course you have to do that because that only brings you more efficiency in terms of cost. Continue to reduce operating costs and improve operational efficiencies, and to grow inorganically as well through strategic acquisitions and alliances. So that's what their strategy is looking ahead to gain more and more market share. In terms of consistency of growth and returns, we already seen, but I'll just pick up some of the important points. So ROE has been very, very steady. It has been around, so in the FY21, FY25, it is around 16.3%, but it has always remained 15% plus or so. ROC is also very fantastic. It has been about 20% average, we can say. And in FY25, which is going on, it's around 18.3%. Even if you see net EBITDA, which already seeing net debt is already continuously decreasing and it is reached to around zero point 0.1. FY25 is still too close. That number will come down, and fixed assets turnover is also very good. So I think very, very impressive growth and return numbers. That's very impressive for this company. Now we just talk about what is the overall Indian forging industry. So we just spoken about Happy Forgings, but we have to see in the overall context of the entire forging capacity of India, how it looks like, and within that pie, how Happy Forging is performing and how they are placed. So forging is traditionally considered as a backbone of manufacturing industry. We all know that. It's a major input to the sectors which support economic growth of the nation, such as automobile, industrial machinery, power, construction and mining equipments, railways, and general engineering. With an installed capacity of around 38.5 lakh metric tons, Indian forging industry has a capability to forge a variety of raw materials like carbon steel, alloy steel, stainless steel, super alloy, titanium, aluminium, and so forth, as per the requirements of user industry. Our Happy Forging actually come into the fitting of carbon steel, alloy steel, and stainless steel, which they are catering to among this entire pie. So if we see that we have if we categorize how the size of industry are there in India, so very small capacity industry is 59% of the entire pie. Small is around 24%. 9% includes medium. Large is 6%, and very large is only 2%. So what do we see with very large is around, which is greater than 75,000 metric tons. So Happy Forgings come into this category. So they are into that 2% of the industry forgings capacity. For large, you have 30,000, 75. For very small, you have less than 5,000 tons. Small, you have 5,000, 12,500. So that is how the that is how the classification of forging industry in India stands. If we see the forging industry, it's into broadly four areas. So northern region, you will see that there are total forging units of 129 numbers. They are mostly into Ludhiana, Faridabad, Ghaziabad, and Gurgaon. So our industry or our stock, which is we chosen, is into Ludhiana. Western region, you have 147. In southern region, you have only 75, and eastern region even less of around 27. So majority of the forging industry are either into northern region or in the western region. So Indian forging industry, as of now, it's contributing around 58% to the automotive industry. So if you see our Happy Forging also, mostly the businesses comes from automotive only, and non-automotive around 42%. So in Happy Forging Limited, they are giving to power generation units, they're giving to windmills. So those all become a part of non-automotive. So that's a mix of how the forging industry in India is divided in terms of business. So now we'll go to the how the growth of Indian forging industry is looking like. So Indian forging industry is looking like to double from or more than double from 2022 to by 2030. So 4.43 billion USD dollars industry will actually become 9.75 billion dollars industry with a staggering CAGR of around 10%. So it's almost equal to our nominal GDP growth. Our nominal GDP growth generally stays around 10%, and probably this industry will also grow around 10%. So it's approximately 1 to 1 ratio. That's it's a good CAGR. So Indian, if you talk about metal growth factors, why this forging industry will continue to grow is because increasing demand for forged products in power, agriculture, aerospace, and defense to drive industry expansion, increasing export of forging products to drive market growth. The restraining factor is only power, but I think government has solved a lot of power problems now, and we are actually slowly becoming power surplus. So that may not become a restraining factor anymore. In terms of product wise forging industry, so if in 2022 if we see, so carbon steel forms a major part, and our anyways happy forging is into this particular segment, into majorly into this carbon steel segment only. How the Indian iron steel industry is looking like? So they have robust demand. So India's finished steel consumption stood at 119.17 million tons in FY23 to, and it is increased to around 138 million tons in FY24. The Indian Steel Association anticipates that steel requirement will reach 128.9 million tons, so that's fantastic. And the industrial domestic steel demand is expected to grow by around 9%, 10% CAGR, which we already seen in the previous slides. Increasing investment, so this industry is witnessing global consolidation of players, which has led to investment by entities from other sectors, and the ongoing consolidation also presented opportunity to global players to enter into the Indian market. They have also PLI schemes, which is given by the government. So that's again a good, good component of the for the industry. We always have a policy support because it's a very large segment in India, and government also understands that this particular is a very input raw material to major industry. So no government can take this particular sector lightly. So government has implemented various measures to promote self-reliance in the steel industry. Under the Union Budget 2024, the government allocated around 70 crores to the Ministry of Steel as well. A competitive advantage, the production, easy availability of low cost manpower and presence of abundant iron ore reserves makes India competitive in the global setup. So that's the biggest advantage. India is home to fifth highest reserves of iron ore in the world. So that makes us advantage because the cost of input will decrease because raw material is available in India. Now we come to the fundamentals. So if you see the market cap of this company is only 1900 crores, so which means it's a huge road to grow from here on. The stock P is around 37, not much, not less, so it's pretty median. ROC is very staggering, 22%. ROE is very staggering, around 18%. The book value is 182 rupees. Sales growth have been phenomenal, around 32% for last 3 years. EPS is around 28, which is trailing 12 months. Promoter holding is also fantastic, 78%. They are very high on cash, around 1700 crores. Price to book is 5.73, which is quite okay. Intrinsic value itself is around 520 rupees. Again, very impressive. They gave less dividend, but that's fine. The debt is only 148 crores. So with respect to the reserves, is less than even 10%. So that's perfectly fine. The fundamentals are extremely. So one of our friends has given me advice that I should not invest too much of time in PPT, and probably all the financials and all can be shown directly in the scanner. I like this advice, so we'll do that. So I've opened the scanner for Happy Forgings. We've already seen the fundamentals, so I'll just skip to the financial part now. So this is the chart. So if you see uh, the chart also, it's the IPO was around probably around 1,000 rupees or so, and it is still trading at the same price. So and a lot of demand for this. It's very liquid stock, so there is no problem in that, and it's a very nice chart. And it has come to a recent correction also. So from around 1250 or let's say 1270 rupees, it has been corrected to around 1050 rupees or so. A decent correction of around 20%. So this is the right time you can start entering into the stock depending on your interest in the stock. So that's how the chart is. The company has reduced debt. The company is almost debt free. The company has delivered good profit growth for 20% CAGR over the last 5 years. We've already seen that. So that's again a good thing for the company. It has no cons, so that's again very good thing uh, from the fundamental point of this company. So we'll just skip this peer comparison, not required. So now if you see the financials in terms of operating profit, So it has increased from 73 crores in December 2022 to around 105 crores in September 24. So that's again a good growth. The operating margin has been very good. So 25% in December 2022, and they've maintained that. In fact, they've increased it to around 29% by September 24. So very high operating margin, extremely high operating margin. The profit before tax is also increasing to 56 crores from in December 22. It was now reached to around 97 crores in September 24. So again, a good decent growth. The net profits also has increased, and similarly the EPS has also increased from 4.65 to 7.58 in September 24 versus December 22. So again, a good decent growth. In terms of profit and loss, again, if we compare from March 2018 to March 24, or let's say trailing 12 months, so from 137 it has increased to around 400 crores, almost four times in last 7 years. Again, fantastic. The what I like, the beauty of this company is operating margin. They have very steady on the operating margin. So 25% in 18, 27 in 19, almost the same range. And in March 24, they have reached around 29%. And even the trailing 12 months basis, they're on 28%. So even during the time of COVID, anything had happened, but they've been able to maintain their operating margin. So fantastic in that way. Even the profits have been steadily increasing. We've already seen that from March 18 of only 60 crores, around 58 crores, they have reached to already 260 crores, so almost four times in last 7 years or so. So staggering growth, very extremely good fundamentals. Sales growth has been, so if you see the trailing 12 months is 9%, but over the last 3 years have been 32%. The profit growth has been 41% in last 3 years, and even the return on equity has been around 20% in last 3 years, and last 5 years 19%. So extremely good fundamentals. Balance sheet is good. We already seen. So they're sitting on 1692 crores of cash, and borrowings are only 148 crores, even less than 10%. Fantastic in that way. No issues at all. Cash flows are good. Anyways, it's a company with order driven, so they have no issues in terms of cash. They're anyway sitting very high on cash, so no issues at all. ROE is again fantastic. So if you see about 20% average, they maintained for last 7 8 years. I think fantastic. So return on capital employed (ROC) has been fantastic. That's again makes a good fundamental part. Shareholding is also very good. So DI is almost owns 17% of the stocks. Promoter we already seen it's around 78%. That is also very high number. I always like companies with have large promoter holding, because that makes the promoter always interested in the company's growth. Because if the company grows, his stock price grows, his business grows, then his value or net value also keeps on increasing. And DI is on owning 17%, so that's again a staggering figure. FI is also on around 2.2%. We all know that if at all DIs and FIs are buying these kind of stocks, which means they have done very big research. They have big teams to do all this research, and if they're invested, they're pretty sure on the fundamentals and the company's overall composition. So that's on the company's financial parts. So if we talk about the awards, accreditations, and recognitions from this company, so in 2024 they were given the Gold Award for superlative performance and agility by Ashok Leyland Supplier Summit. They received Next Level Quality Award by Generic 2023, Best Quality Award by Escort Kubota in 2024 again, Supplier Excellence Award. They were given Best Supplier Award by TAFE. This was in Global Supplier Meet 2024. In 2023, they were again given Supplier Excellence Award by American Axle Manufacturing. They're given the award for overall outstanding contribution in gear business by iShare Engineering Components. They received the ISO certification for 14001 2015 and 48000 and 2018 accreditation for manufacturing of forged and machine components and excluding product design degree facility. They received the Entrepreneur and the Leadership Award at JCB Annual Suppliers Conference. They received a certificate appreciation for. This is from Business Excellence Process Digitalization by Escorts Kubota. In 2022, again, they had good awards, and 2021, they received the accreditation from ISO 48001 for their Kangwal Facility 1, and they received IATF 2016 accreditation for manufacturing of forged and machine components without product design responsibility with extended manufacturing sites at Kangwal Facility 1. So that's how the awards, accreditations, and recognitions stand for this company. I think good set of records and rewards and accreditations, and you can see they have been getting all these awards from very renowned industries or associations and all, which makes it even more exciting to probably own this company. So that was the entire stock analysis on the Happy Forgings. I really like this company because it is catering to a manufacturing led story of India, which is only going to grow. This company has a very variety of products. This company has a product which have high entry barriers. This belongs to industry which is growing at a CAGR of around 10%. The owners are very good. The promoter ownership is good. The fundamental of the company is very good in terms of ROC, ROE. They're sitting on cash. They have low debt, and they have very niche customers which they will continue to give the products. So the loss of business is not there, the loss of industry is not there. So considering all these important facts, I think this is one company which can be owned for next 15-20 years, and this particular stock have the potential to become a multi-bagger. So that was it for today. Thank you so much for your time, and have a good weekend. Thanks.